I hope you all recognize Hugh from a very famous hedge fund guy. And Hugh, I'd like to keep this flowing pretty quickly. So let's kind of target 1 minute maximum per answer and save the speeches for the politicians and just keep it tight, okay? Okay. Let's start with some background. Assuming we have 400 wannabe hedge fund managers here, how did you become a hedge fund manager?
Predestination. God chose me to pursue this path. So I spent 10 years being abused and poorly thought of. But I worked for a very eclectic investment management business in Edinburgh, who rotated young children. So I was started at the age of 21 and thrust into the Japanese stock market the year after it just peaked back in 1990. And then you're just getting up to speed, and then he said, I think you should do UK large companies. And then a year later, you're just getting up to speed, you should do US equities. So rotation. But I'll never forget, I had to do a monthly presentation to the partnership and to the investment staff. I was 21, and I was in this Georgian building. And you had to write a paper, and I swear, if you're English or if you got one error in it, you were absolutely destroyed. And I remember once I was encouraged to have cards, and I'd written messages. We'd been on a presentation, how to make effective presentations. And I had, I had lots of happy, smiling faces, and be happy, you relax, don't worry. And I turned the cards around the wrong way, so they're all looking at my cards, and they thought I was an idiot. They might have been right.
And now you're a hedge fund manager.
And yeah, I moved to London in 1998 or 99, and no one would employ me because, again, I wasn't a master of any one discipline. I'd spent a year doing this, whatever. And so I was a generalist, and no one wanted a generalist, but it was perfect training for a role as a hedge fund manager. And I worked initially with Credit Suisse, who I thought it was a different environment, less intellectually stressing environment. But I was very fortunate that I met Chris Minodi, who was perhaps the first or one of the first hedge fund pioneers in this country. So his hedge fund set up in 1991. And I had dinner with him, and he said to me, I think you're like us, you're one of the pirates, and I'd like you to join my ship.
And you once said that you wanted to short people like you. What did you mean by that?
I still do. I have contempt for myself, and it's only justified by my equal contempt for others. And it came from, I have an economic theory, which is social interaction with economics. And so we know that famously we had the market crash of 1929. We know that the stock market fell 80% within 2 years. But I think less widely understood is that there was a revulsion of debt and leverage within society. And that changes very slowly. And I would argue that it finally was eradicated from society in 1973, 1974. So 40 years later, it was finally gone. And then we moved on to another cycle, which was, again, its opposite, taking on debt. So I've been in this business for 20-odd years, and I've been in this upswing, and it just paid to be optimistic. And I just hate optimists. And for 20 years, the optimist just got paid out. So that's where the loathing comes. And it's got to a point where the financial economy has become the economy. And I think we could be subject to another one of these generational shifts whereby really I should be attending the Young Farmer Society as opposed to London School of Economics.
And as a hedge fund manager, you've been in it for 20 years. How do you measure success? Is it annual performance? Is it long-term track record? Or is it YouTube hits? And before you answer that, we have a clip. Can you guys play the video?
I think there's something in that. I think what a lot of people, you see what's happening in the gold markets. People using gold as a hedge. You see people using land, timber, water and wood as a hedge. We're starting to see the basis of this now in the oil markets with, again, despite newspapers around the Western world banging on about demand destruction, we're actually seeing futures markets pointing upwards strongly, ever more.
Hugh, this is somewhat at odds with your view this morning, isn't it? Let's bring you into the conversation around the desk. I mean, Liam's put out a case.
Yeah, sure, but I'm sure the viewers who've been, if they've been watching the show on a loop now for a while, will have noticed something. That these guys keep coming on, and they keep saying the same thing, but they keep thinking it's a minority view, right? It is, Liam, you ain't a contrarian, right? It is not.
Well,
It is not. It is not.
With respect,
it is not a minority. It is not a minority. It is not a minority view. It is not a minority view to say you want to buy index-linked bonds. It is not a minority view to say that you believe there's going to be inflation and that you're shorting bonds. You are so consensual. Yeah. Please do not. I mean, best of luck with that strategy, but don't perceive yourself to be contrarian.
The basic point here is there's no problem of Greece or Spain meeting their interest payments. Even at a debt GDP ratio of 130%, with real interest rates at 1%, 2%, that's a small fraction of GDP to meet their interest obligations.
Hugh, you're shaking your head.
Hello. Can I tell you about the real world? Greece is paying 7% on 2-year money. That's not, let me tell you, prices are falling. In real terms, we're talking about 9%. No. What you refer to is you refer to the rate for the non-cheating countries, right? So you have fiscal probity.
This is not cheating
if you organise your country in a sensible manner and show fiscal restraint.
They have that.
Just like you finished.
How on earth can you possibly? Greece is a cheats charter.
Have we got the time?
Well, the problem is, in the last few years...
Well, how long have we been at this? How long has this Greek question been on the table? About 10 weeks, maybe?
I mean, I don't know. Was Jeffrey skiing 2 months ago? Because I was working and Gillian was working, right? So we can tell you about the real world, because it doesn't go back 2 months ago.
That's just very low.
This is preposterous. To say that this started 10 weeks ago is the height of absurdity, right?
I'm talking about the market reactions right
speculators
now. So just watch your rhetoric a little bit.
Speculators who are engaged to be alert to dangers in the market. We're calling for these potential threats to the viability of the system last year, not 10 weeks ago.
Mr. Henry, I can say to Mr. Hendry, you can say farewell because you never learn, and we're going to stop your attacks on ordinary people's future.
Mr. Rasmussen, are you worried, Hugh Hendry?
He should be worried. These champagne socialists, yeah? When I travel business class, I meet these guys. I meet these socialists, yeah? These socialists who travel business and first class through the prosperity created by entrepreneurs and risk takers like me and the people that I represent. Now, we are confronted, our society today is confronted with a bleak future owing to poor policy decisions. The truth today has become unpalatable, and these jokers don't want to hear it. They are now afraid because the magnitude of the problem confronting Greece is now greater than these guys and their ability to respond to it. So now they have to apportion blame elsewhere. And I am a convenient scapegoat for Greece breaking all of the rules.
Hugh, as a hedge fund manager, how do you measure success? Annual performance, long-term track record, or YouTube hits?
I tell you, I'd be so rich if it was measured on the latter. And I tell you, my clients have banned me from media presentations. It's very frustrating. It's not good for business, which is just a reality. So when my performance is good, and I feel like I'm a risk taker, I go on TV. Just now, actually, my performance is poor, and you won't see me near a TV camera. So.
You really seem to hate Greece. Did you have a bad holiday there or something?
I did. I turned up my daughter, I think, was about 9 months, and she threw up all over.
But what is it about Greece and the euro? Do you think the euro experiment's going to work? Is it going to fall apart? Is Greece, Portugal, Spain going to take it down?
I think it's mortally wounded, but I think it has the capability to limp on for some time. I think that the tragedy is that ordinary people are being used as collateral damage in order to persevere with a political model which has poor groundings in economics. And I think it's finally resolved when the present generation of politicians in Europe are evicted from office. That process will begin shortly in Ireland, but it's really going to be determined when there is an opposition party in Germany which reflects upon the views expressed in the popular newspapers there. The shock that I have is that presently the German opposition, they are on a platform which claims that the German people should be paying out money quicker than they are just now. I don't think that's in lockstep with the popular view of that country. And when that changes, when they have political representation, then I think we'll see the undoing. So troubles are there, they're obvious, they're identified by people in my position, but it's a very expensive area to speculate against just now.
So the way you see it is Germany leaving the euro?
Not necessarily. There are many turns on this screw. I just think it's a great tragedy. It's a tragedy that Europe, we're revisiting, because it has many, many parallels with the 1920s. The euro, as it was, seems to be perfectly in sync with the way the gold standard worked in the 1920s. It's created imbalances that we saw back then, and the policy response again is as flawed as it was in the late 1920s. So it doesn't make me a very enthusiastic risk taker, if you will.
But isn't policy response and the short-term nature of the political cycle always going for votes what creates opportunities for macro hedge fund managers?
Yeah, I mean, you're right. I mean, the macro opportunity is determined by the interaction of economics and the ability of the politicians to fudge that. The macro opportunity in Europe is so difficult just now because the flaws are widely understood. When you're putting on macro trades, the best macro trade, the best trade of any color is when you don't fear the consequences of being wrong. So that's all about a question of optionality. It's all about how much as you set up the trade on an ex-ante basis, how much does it cost me? How much does it pay out if I'm right? That model, or the pricing model that we see in Europe, such as CDS and the like, is challenging, and therefore you have to be, I think the economist used the term oblique, you have to be kind of thinking of other aspects. So we talked about Europe, we could talk easily, and just as easily about China. China's playing this role as...
Hold off on China, because we'll get to that.
Okay.
Speaking of asymmetric trades, the subprime short was probably the best trade of the last decade, if not the last, since we've been trading.
Since the beginning of time, yeah.
Did you catch that?
No. But Greg Lippmann, who was one of the pioneers in that trade, he
didn't swing by your office?
He was in my office, yeah. We had the curiosity and we wanted to put that trade on. But it's a fantastically, fiendishly difficult trade to set up with regard to how you value and monitor the trade in the months before it makes you money, even indeed in the months that it does make you money. And it's a question of administrators and a lot of boring things, and we had to pass because we weren't set up to take such a convoluted trade, if you will. We trade liquid, deep, open markets, which was a difficulty, but that's fine. I mean, we had curiosity at the right time, and the gods that be, the powers that be, determined that we weren't to make money on that trade. We would make money at a subsequent point.
And getting back to the European periphery, in 2005, you spoke at the Drobny conference in Reykjavik, and you said you wanted to be known as the man who bankrupted Iceland. Was that mission accomplished?
No. That's a very revisionist take on history. I said nothing of the like at your conference in Reykjavik, but about a year or 6 months prior to that, I was interviewed by the London Times, And when they asked me about your great heroes of the world of macro investing, of course the subject happened upon George Soros. And they opened up the analogy with George and his great adventure with sterling, and therefore put that point to me. And I foolishly said yes. And of course that marked the highest profit I had on the figure. I mean, I had a huge figure. I was hugely short Iceland. I was running 200 million, I was long $200 million and short the Reykjavik on the other side. That's a lot. It was a very illiquid market. But my curse is I'm always early. So I came out of that trade flat. But I recall your conference because I remember serenading Nouriel Roubini. Roubini was there. And I sang to him the Oasis song. You and I, Nouriel, we see things differently. We will live forever. I think I'm still here.
We have another video clip. So we can move on to the elephant in the global economy. Can you play the clip? You might need to crank the audio because this one's not so good.
And of course, we're looking for tenants. In the CBD, Central Business District of Guangzhou.
So I'm thinking this is either ironic or there's a message here. Here we have the China Galaxy Securities Company. This is a stockbroker. Look what happened. This perhaps is a throwback to another era of asset speculation. It's empty. The horns on the bulls have gone. There's a story there. At some point, we might find out what that story is. I keep thinking of Russia. Russia had lots of reserves, foreign exchange reserves, lots of formidable strength until the economy slowed down. What did they do? They spent all of those reserves trying to prevent the inevitable. Now Russia has no reserves and has a weak economy. Is China set to follow the same path? Behind me is this is a seriously large building. We're talking at least $500 million to construct this thing. The new China, the exciting element of China. The one flying the ointment is check over my left-hand shoulder. It's empty. Who is going to fill that space? Who is going to pay the debt that building is resting on? This is astonishing. People are taking photographs. This has been sitting empty for months. A building with no tenants. $500 million of someone else's liabilities. And it's not just one. Because behind, look over here, this place is empty as well. These are buildings you associate with Manhattan. These things don't come cheap. And they're creating no renting. Let's go and check this one out, Paul. So you can see over my shoulder that very expensive empty building where the developer went bust. The scary thing is, if you come over here, we have another office building. My message to the developer is stall. They're going to run out of cash.
That's it. So my first question is it normal in Scotland to wear your ski coat under your safari suit?
I so hate you.
Second question. Why are you so harsh on China, a country that's going to save us all from ourselves?
Indeed. Well, it's a very large country and it straddles both the northern and the southern hemisphere, and I was traveling across both. Therefore, I had taken my winter suit and my summer suit, and on that day it was so cold I was wearing both, to answer your first question. Second question, why so hung up on China? I'm prejudicial, clearly I'm prejudicial with regard to the model of economic expansion that China is pursuing. I'm prejudicial because I don't think it's a particularly unique strategy that it is invoking. It's certainly, the uniqueness is the number of people involved rather than the actual strategy. And the strategy, I think, is based, the premises are based on softer issues, softer versus my hard issues of profit. The economy is being directed with regard to notions of sovereign profit as opposed to corporate profitability. And I'm sympathetic to why. History is replete with examples of Western interference and arguably poor interference with the matters of state in Asia, and therefore it's only natural that they should approach the future with trying to create autonomy, and more than that, to actually create a state of affairs with current account surpluses, whereby they can almost dictate our affairs. Now, they seem to be on the brink, or perhaps have achieved that latter objective. But when you are directing capital investment, or you're directing economic resources within your economy on the premise of sovereign power as opposed to economic power, economic value added, returns on capital, then you're building foundations, I fear, on sand. I think the Japanese pursued this model. They pursued it successfully until it was revealed that it was again predicated on quite weak foundations. If you're spending money without any intent of earning an economic return, you're spending money poorly. So my feeling is there isn't a Confucius saying, but I'm sure you've heard me say it before. If there were a Confucius saying on this subject matter, it would be, wise man not invest in overcapacity. So you saw me outside a large building in Wuhan, in the center, close to the center of China. And my point to you is that as you build that property, that speculative property, you could well spend $500 million with regard to labor, steel, glass, cement, etc. And in doing so, your endeavors and the endeavors of those who work for you would contribute to the GDP calculator. You would be ensuring that China grows at 10%. But the delivery of a speculative property without tenants into an office market with a vacancy of 20% is not creating wealth. So my take on China is I can see a division or a conflict between GDP growth on the one hand. They're very successful at that. But on the other hand, I worry about their ability to create sustainable wealth.
And how do you play that? Are you short China? Can you buy CDS on China? Are there subprime shorts you can put on there?
So this is where you have to be creative. I have survivorship bias. I've been doing this for 10 years, which means I've got some things right, but my goodness, I've got so many things wrong. But I survived all the silly things that I did. And so you get some wisdom from that. And the wisdom that you rapidly accumulate is that shorting is a torturous and treacherous occupation. This unlimited loss is rather fearsome. So I mentioned the notion of the solar system and the analogy with China. China today is the equivalent of the sun. It's very much determining movements within our world, both in the West and closer to China. I want to go against that grain. Now, you find out if you get closer, the closer and closer you get to the sun, you would melt. You couldn't hold your position. It's too hot, if you will. So it's very important when you're building a position, this contrary position to Chinese growth, that it can't be too close to the mainland of China. So you can't short equities in China. You can't short them in Hong Kong. You can't short commodity equities like commodity futures, rather, like copper, or their equity derivatives in the West. Because if you had, I'd have been stopped out. The reality is I've had this trade on for a year. I've been wrong. And yet I still have the position, which, so I'm thankful for this ex-ante posturing, if you will. To answer your question, we've used a satellite, we've used the dark side of the moon, if you will, we put something between us and the heat, the direct heat from the sun. So we have put together a basket of Japanese industries, and we have bought CDS. We've sought protection for the creditworthiness of these businesses deteriorating. Now, Japan is very, very reliant upon trade, obviously, with China. And we've been able to identify industries such as steel. Now, if you study economics and if you do microanalysis, it's very rare to find an industry like steel which is exported. Steel doesn't largely get exported across great lengths of water or land. So you have a steel industry which supplies your domestic needs for the product. But in Japan, they export 1/3 of the output, which has been a great savings, a great blessing, because, again, they committed to too much capacity in the 1980s. But it opens up the conjecture that effectively you've given your clients a put option. They're not obliged to take your steel, far from it. And so what we've observed is that the Koreans, who were the largest importers of Japanese steel, they are now, through the virtue of Hyundai and POSCO and their capital expenditure, Korea this year will become a net exporter, so it no longer needs to import Japanese steel. And so you have the possibility that some of these industries can have the Irish rate of change, if you will. You can go from hero to zero very, very quickly, and that would certainly be predicated if we saw any slowdown in China.
And if you're bearish China, can I assume you're bearish the US, US equities, US dollar?
Oh, no. The life gets complicated. There is, of course, much talk these days about gold, and there are many incredible forecasts for the gold price, 3,000, 5,000, depending on who you speak to. Gold today is about $1,400. And that interest in gold is representing a fear about fiat money, and it's representing a fear that central bankers, again, are more politically motivated and will do filthy things like printing money, so we know about the debasement of currencies. It's hard to debase gold. You know. The genius of God, I remember saying, God is a genius because he's a sloth. You know, it takes 1 billion years to make an ounce of gold. The problem is we have these godlike deities at central bankers, but their undoing is it takes them a nanosecond to create $1 billion. Yeah, and that's the dynamic which is pushing gold up. But if you believe in this notion of the future being one of hyperinflation, it's a bit like the wise man getting into heaven and the need to pass through the eye of a needle. I think it's very like that, in the sense that if we're going to have hyperinflation where the dollar loses all of its value, which is an extraordinary thing to say, and yet it's almost become common currency in some financial media. For that to be a reality, you need like a meteor to hit the earth. You need something profoundly negative to shake the course of economic growth globally. Because only if that happens, will the central bankers be called forth into this dramatic policy response, which would create this hyperinflation. So that's why I come back to notions such as China and indeed sovereign Europe having some restructuring event. These are the economic equivalent of a meteor hitting the earth. And if that happens, you will see central bankers go to extraordinary measures. So just now I'm pursuing what would be called a bearish macro view of the world. I'm looking for a kind of tail event such as China having a reversal. I think I can capture great profits through my credit portfolio in Japan. One of the functions or the catalyst for that coming through is I think the yen could appreciate greatly. I also think the dollar could appreciate greatly because they have so much debt denominated in those currencies. And if asset values take a hit, there's a relationship between collateral values. You actually create a shortage of yen and dollars in an environment where asset prices fall. And that's all a precursor to then wanting to buy one-touch Nikkei calls at 40,000, 50,000, 60,000, because if we get an inflationary response, then I want to be very long equities.
Any countries you're positive on? Okay. I want to move on and get into inside the head of Hugh Hendry. I've asked the conference organizers to arrange a couch. If you'd like to It's your choice. If you want to lay down, we can get in, or we can stay here.
I'll stay here.
We want to get deeper into your psyche. You said you make investment decisions based off the voices inside your head. What do they tell you?
Well, I went one step further. Again, this all goes back to this blasted article I did with the Times. So not only was I the man that wanted to short Iceland to zero, I proclaimed that I was a paranoid schizophrenia. I was schizophrenic. So I heard voices in my head which led me to take actions. And as I took the actions, I became very fearful of the consequences of my actions. That sounds like paranoid schizophrenia to me. And that was based on my earliest report cards hit upon this. There was this line that said, lovely child, whatever, but my goodness, for a 7-year-old, he worries. He's such a worrier. And if you think I've gone on and I've made a career out of worrying, I take actions and then I'm profoundly fearful of the consequences. This is a torturous, this is my first speaking engagement of the year, and I'm a bit rusty. But I'm not making money just now. I mean, I fear waking up and turning my BlackBerry on just now. I mean, I'm not losing a lot of money, I'm just not making money. And I hate that. And there's a whole debate going on with British inflation just now, which I think is flawed, but it's a reality that's going on. So, I mean, I now wake up early just so I can anticipate feeling miserable about actually waking up at the right time. So to be on this stage is interesting. So, but it's the key. That's what a hedge fund manager does. You're very fearful of the consequences of your decisions, and therefore you give great weight to them. And if you're skillful, you're not a hostage to your errors. If you're not a hostage to your errors, the future is rather promising.
So, living with this worry and this fear of your BlackBerry, I mean, longer term, what are your goals and aspirations? Do you want to get into politics? Do you want to be a philanthropist? Do you want to be a billionaire playboy? What do you want to do?
I mean, if it's mutually exclusive, then I think I'd go for C. I think my wife might have something to say about that. I think that hits back on one of your questions. How do you measure your success? This is a very strange business. Again, I don't know if we mentioned it in the interview, but it's like mirror, mirror on the wall, who's the prettiest of them all. Can you imagine that you had like every moment of your day, you had a little thing that gave you feedback. You'd say, how am I doing? And it'd say, rubbish. And then you'd ask again, and it'd say, oh, okay. And then you'd ask again, and say, no, rubbish, 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 rubbish. My performance is marked every second of the day. It drives you crazy. Now, I set up my hedge fund when I was a partner with another business, with Chris Spinodi, and I chose to leave. But I bought the right to manage the fund. What happens typically is that you have a fallout, you close the fund down, and then you go away and you raise fresh money. I didn't want that because I had a track record when I was leaving, and I wanted to preserve that track record. I'm not sure the person who is talking to you, I'm not sure if I'm an idiot or a genius. But what I know is there's an envelope in the future, and it has my 10-year compound annual growth rate. And there's an envelope that has my 15-year and my 20-year. And I'm desperately intrigued as to what the number is on that envelope, because that will determine my impression of who I am.
In the movie Wall Street 2, I don't know if you've seen it.
Terrible.
It was terrible. It was terrible. But the new Bud Fox character, Sheila Booth, is talking to the evil financier, Josh Brolin, and he asks him what his number is, his number to get out. And Josh Brolin says, more. What is your number?
Yeah, there isn't a number. I'm incredibly fortunate. I mean, I spend a lot of time loathing myself and being desperately unhappy. I mean, again, back to a very influential figure on my career was Chris Spinodi. And I have to say that when he dies, not to suggest he's going to die, but it will say, there goes someone who lived life well, and I think that's a fantastic compliment. And I'm not sure you could write that on my tombstone. I'm so caught up in self-doubt. Again, that's why I'm so desperate for this envelope to drop and tell me, because I'm just desperately insecure as to who I am. So again, thank you for showing the TV screen. The first thing we saw was with Liam Halligan. I find just obnoxious. I say that because I'm obnoxious. But he ended my career on CNBC because when I watched his passion and his ability to come back, if you will, I saw myself and I didn't like what I saw. And so I stepped down. And then I started doing Newsnight because I thought no one watched Newsnight. That was wrong.
Let's play a word association game, okay? So I'll say a word, and you say the first word, or shall I say voice, that comes inside your head, okay?
Well, that's easy, fuck.
And let's go quick here, okay? Trichet.
If you add a T, then you get the rich as a word game.
Trichet?
I read The Economist this week and it says the rich, and I thought it said Trichet because I was thinking about Europe.
Obama?
I was misquoted in the New York Times. I said you should short Obama. I said social mood is a great thing when he was held aloft on the shoulders of men and women at the inauguration. I reflected upon that being a great moment if one could short such emotional discord. But it got misquoted as I just wanted to short Obama, and he was down at that point, and he seems a nice guy, but whatever.
Bernanke?
Evil genius.
Greenspan?
Evil genius.
Sherry Blair?
Ugh.
Vladimir Putin?
Evil genius.
David Beckham?
Oh, who cares?
Mervyn King?
I like the king. I like Mervyn.
Facebook?
Who cares?
Julian Assange?
Yeah, I kind of care about him. He's kind of, he's interesting.
Black Swans?
Looking forward to the movie.
London School of Economics?
Yeah, I'm kind of curious to learn more.
Tomorrow at this conference is Private Equity Day. Today's hedge funds, tomorrow's private equity. What is your thoughts of the private equity world?
I don't get it. I don't get locking up your money for such a long time. I find it even more opaque than the hedge fund world. The hedge funds, when I run my hedge fund, I do run my hedge fund, but we've always insisted on, liquidity. It's other people's money. I'm the third or the fourth largest investor in the funds. It's my money as well, but it's other people's money. And therefore, if you have money in my fund, you can get it back monthly and 5 business days notice. And that's an enormous sharp pencil pressed up against my spine that says, don't you dare take it easy for one moment of the day or of your life. If you do, if you muck it up, I'm taking the money away. So focuses the mind, if you will. Remember Bertie Hiscox, who runs his underwriting syndicate at Lloyd's, one of the most successful underwriters in the history of Lloyd's. And he said that when he put me in front of the room of his underwriters, and he said, I've got a sharp pencil pressed against the spine of every one of these underwriters. If they dare make a mistake, it goes in. And there's one of the best hedge funds in the world is located in London. And they had an interesting experiment where they set up a new fund and they had a 3-year lockup versus, again, a more liquid version. And through the tumult of 2008, the difference in performance was dramatic because the person who had the 3 years the money wasn't going to be pooled was the person who lost a great deal of money that year. Whereas the person who had that sharp pencil was endeavoring at every moment and actually came through the year with a very respectable performance. So that's what I understand. I don't see the sharp pencil with private equities, which makes me suspicious of it.
And in 2008, which was a disastrous year for 99.9% of all investors, you had a very strong year, and your investors redeemed.
Yeah. Yeah. Well, again, it was we had a very good month. We made 50% in a month, which is kind of preposterous and not meant to happen. We had option premium on the basis of the spread between the 10-year Treasury and the 2-year Treasury widening. So it's predicated on the market believing that interest rates would remain low for a much longer time, a kind of Japanese scenario. And that came true, if you will, very dramatically with the disaster of Lehman's, etc. And we made 50. But the clients were losing money elsewhere, and they had a legitimate desire to call upon us to return money. So there was a good situation. We made a nice performance fee on it. They got their money back. Our reputation, I think, was enhanced by that activity. And the reality of being a successful hedge fund manager, I'm not the reality. I'm the antithesis of that in many respects, because the reality is you do no media. You cannot string words and sentences together. Sometimes I'm better than that than today. And you're boring and predictable, and you just make small amounts of money. You know, someone like Brevin Howard today, they have $30 billion, and their ambition is to make 5 or 6%. It's not to make 50 or 60%. The worst thing you could do is make 50%, as I discovered, in a month. So it's a strange, strange world.
In the interview in the book, you said your goal was to become like a piece of plasticine. And that's why I called your chapter The Plasticine Macro Trader. What did you mean by that?
Again, it's emotional intelligence. There was a fashion for a time for having like words like conviction and focused, having a focus fund, a best ideas fund. These are remarkably emotionally loaded terms. So this Danny Boyle movie that's out just now with The Climber, I thought that was a great example of the paradox of being a risk manager. You know, the climber, and he's on his own, and he gets trapped, and it's his arm that's trapped, and he's running a very focused fund. He only has 2 arms like the rest of us. Yeah? And so he recognizes rationally that he's got to let go. He's got to liquidate the portfolio. One of the arms has got to go, but you know, it's not easy. Not easy, 2 arms. You know, and that's a fabulous story because it's the opposite of what we'd all be dead. Yeah, I mean, who amongst us would have the guts and the courage to saw off the arm? Yeah, and I liken that to the world of investing. We spend so much time, resources, and money trying to see the future. Really, we're spending money trying to delude ourselves. You have no chance of seeing the future. Yeah? And it's better to recognize that. So again, as I think about it, the worst thing that happened to Western civilization was the US government's program in the 1970s to try and reduce fatalities from road accidents, and that led to the creation of the inflatable, the airbag. Yeah? And it cost billions to achieve. If they'd asked me, I would have invented a sharp object like a dagger, and I'd have had it in the steering wheel. And you would eliminate fatalities because, my God, you would drive carefully, yeah? And there's a book by a hedge fund manager. I was sitting in bed last week reading a story of another hedge fund manager. And he was running a statistical merger arbitrage fund. So kind of the gap, a conglomerate maybe trading at a discount to some of its parts, and then you kind of try and take market risk out. He was running market neutral. And I was reading, being deeply impressed by the intellectual rigor that he was applying to his ideas. And then he then goes on to record an experience in Dallas, I think it was, in Texas, with an oil rig business. And there was one of his competitors, and the degree of knowledge that he brought to bear on the subject matter. In fact, before he took the position on, he took an engineering course at university to get insight. And all he was doing was building this superior airbag. And in 2008, both of their funds disappeared. They were actually driving their cars too fast. So in some respects, I don't want to know. I had an analyst just left us last year, and he had some fantastic insights on this pharmaceutical business, and he started telling me, and I started getting excited, and I started to think I could see the future, and I suddenly, rather than having a 50 basis point holding in my fund, I had a 250 basis point holding, and of course it had a profit warning, it fell 40%. Again, we had deluded ourselves, this notion that we've seen the future. So in some respects, I go around and I don't want to know. I don't want to do stock research. I want to have that itch that trepidation that says, I don't know the complete picture here. And therefore, I watch things like a hawk, and if the chart breaks down, or I trade, I sell. So plasticine man is someone that you can pull it apart very, very quickly and then put it back together. I used to say, back to the climber with the arms, I was the centipede. I had 100 legs, right? 100 legs, I could let go of 1 or 2. I ain't going to procrastinate. Yeah? And that's procrastination kills you in a business which is determined by risk.
That's it. Thank you very much, Hugh. Is there time for questions? Okay. Anybody have any questions for Hugh? Not for me.
It's a question for both of you. What's the most overpriced and the most underpriced skill in the hedge fund community?
You're good at that, Steve.
I'm not as quick as you, Hugh.
Okay. The highest return on intellectual capital of any endeavor in the world, it would seem, is managing a hedge fund. 2 in 20, indeed. Some of these guys get more than that. Yeah, so it doesn't get better. So if you'd never met a hedge fund manager before, it would be logical to assume that they are the brightest people on the planet. Returns match the resource. When you meet hedge fund managers, I'm sure you gather a different insight. But my point is, so I'm up against some of the brightest. I know you get bright doctors, thank goodness, and I know you get bright other people. But I'm up against some of the brightest people on the planet. And I've never thought it rational to compete with outsmarting them. How do I outsmart an incredibly bright person? Okay. And I want to bring forward and ask you to consider the overlooked aspect that life is odd, and thank goodness life is strange. Strange things happen. And that's wonderful because very bright people tend to be logical, or they're encouraged to be logical in the construction of their thoughts within hedge funds because they're managing other people's money. I was taught to misbehave. No one teaches you to have intellectual curiosity, to misbehave. So my business franchise is trying to get opportunities from the arcane world of paradox. Paradox, okay? To give you an example, famously, we've not had many Fed chairmen. We've got Bernanke, and then you have Greenspan, and you have Volcker, and that spans 30 years, if not longer. And those three are interesting because it's very obvious who they are. Volcker came and he said, gee, we've got an inflation problem, that's the bad news. The good news is I'm going to do something about it. You're in a recession, he raises interest rates. He targets money, he withdraws the rate of growth in the money supply. So very obvious, very hawkish. Bernanke made no doubts in his introduction when he gave a speech in October 2002. He said, I will print money, and I will use the technology of a printing press. We will have helicopters, we will, distribute the money. So very obvious, banana ban, inflation ban, Weimar ban, so you have two, and then Greenspan, we still don't know. Jesus. Anyway, but the paradox is, so here you are, go back to, Volcker comes in August 1979. In October, he raises rates. Forget this 25 basis points, 200 basis points. Does it on a Saturday morning. God, I'd have difficulty with my chocolate croissant, but anyway. 200 basis points. Hey, well, I'll see you when the market opens on Monday. Great. Now, the odd thing is, you'd think that would be fantastic for government bonds because, they've been destroyed by the inflation and you've now got this guy taking it on. He's on your side. Policymaker, he's on your side. And the paradox is, despite doing everything, which was what you wanted, that over the course of the next 18 months, the long end of the bond market halved. Within 4 months of that very hawkish stance, the gold price went into a parabola, and we 25 years had to go past before we saw that parabola, the price high, overtaken. And that was the guy being hawkish. So that's weird. How would a bright guy model that on an ex-ante basis? And then you saw its opposite. Again, Bernanke said helicopters, printing presses, and he's the Fed chairman who resides over the 10-year Treasury at the end of 2008, hitting 2.1%. So hitting the joint low from the early 1940s. Hard to anticipate that. That's weird. But the joy of our life is that weird things happen. And so as you move forward with your careers, I would say that's an underappreciated skill set, the skill set of the maverick, the skill set of disciplined curiosity. That's how I take that.
Or basically, as you was saying before, just do different things. The worst thing I ever see is the perfect resume. You know, no interest. It's got the right schools, the right experience, very orderly, no interest. I like people who've done different things and tried different experiences. And
yeah, I took on an analyst, and he said, "Oh, gee, I'm thinking but he was American, so it's my American accent, sorry." And again, he was from New York. His family, I think, were from Switzerland, but he'd done a psychology degree at St. Andrews, which is a bit weird on your point. And then he's like, "Gee, I think it was a bad decision to take a drink for Dutch courage." I'm thinking, what? You're drunk? I thought, you've got to have secrets. You know, don't tell me this stuff. And then he was a white rapper, and he's still with us. He's still with us.
Of course he is.
We call him Slippers. He's a penchant for these hotel slippers. He wears them in the office.
I kind of want to go back to your point on timing, because you might have all these smart people in the room, but at the end of the day, you're not Robinho. You can't say whenever this is going to happen, and then it might happen. You have to actually execute. And you've admitted yourself that timing isn't your perhaps best part. How do you manage that? What kind of signals are you looking for in the bigger picture that will make you decide that it's the right time to go? And then why are you wrong, and how do you fix that?
Well, again, that goes back to you have to give great thought to how you build the portfolio. So if I'm poor on timing, then being subject to a short position in equity or commodities and being confronted with unlimited loss is clearly inappropriate. So by setting up a budget, I'm willing to lose this amount of money. So my position in Japanese CDS, right? I still have 4 years of life left. So I've got, if I'm right within the next 4 years, I've got a payday. And I know exactly how much I make if those events come together. But more importantly, if it doesn't come together, I will lose no more than 8%. So remember, I've got 4 years of life, and I've committed 8% of the fund's assets. I won't get fired for that. And indeed, I could change my mind and liquidate it anyway. So if I'm wrong, it's not going to bankrupt me. So the clients have the confidence. You have to win trust from the client base, and you have to offer transparency, and you have to show stress testing models, the maximum that you can lose. So, and I've tended to favor options. All I can lose is my premium. If I'm right, I make many times that. So you have to give it great thought on an ex-ante basis.
In terms of timing, do you scale into that position, or do you go put it all on at
Yeah,
once?
I mean, timing is, again, if anyone, inflation, right? If I could just say to people, this is my bugbear. We don't have inflation in the UK today. We might in the future, but today we have a movement in relative prices. Okay, so non-discretionary items such as filling the car up with petrol and going to the supermarket, you can't avoid it. You got to do it, and prices are way up. And you can't avoid VAT unless you're in the black economy. But let's say you can't avoid it. Okay, so those prices are higher. Right? But money's not zooming through the economy. You know, there's not, like, in China you've got 20% monetary growth. So it's not inflationary that side. Wages are only expanding at 2%. So if you think about it, if you continue as a household to commit expenditure to those non-discretionary items, you will find you'll have less money to spend on discretionary items. So there'll be a period of rebalancing. You'll find that inflation in 12 months' time, if I'm right, comes back and it moderates. That's my thesis. But I cannot be an ideologue and just insist that I'm right. Yeah? And the reality is there is policy error. The ECB raised interest rates in July 2008. Astonishingly, Trichet was bragging about it 2 weeks ago. I mean, it's like saying, I cheated on my wife. It's like telling your wife, I cheated on you, honey, but it's like, well, you've had that discussion. It's not a secret, but she knows you cheated on her. We'll come back to that. Not a good metaphor. I haven't cheated on my wife. God forbid. But there's no point. So it's better, actually, to have the expectation of policy error. So I have if I'm wrong just now, it's going to cost my portfolio on my rate side, I stand to lose 2.5%. Yeah? There's no surprise. I know, my clients know. If I'm right with what I've got on just now, I might make 8 or 9% through the course of this year. What I'm hoping for is a policy error where we see the Bank of England or the ECB actually commit and actually raise rates. At that point, actually, I think you see a further sell-off in my markets. And rather than being forced out of my position, actually I will be speculating and actually building my position. So yeah, there's some tactics which are necessary.
I know that you have insisted that you want to keep your clients' confidence in the fund. However, the hedge fund industry is really shabby and doesn't disclose many things, and many of the panic that on the past crisis have gone is because of that lack of disclosure. How open are you with your clients, and how open are they to go?
I think the view that it's non-transparent is a pre-08 perception. Post-08, money has come back, but it's come back to the managers that offer liquidity, transparency, openness, because the investors pre-08 were private investors, high net worth. Post-08, it's institutions, pension funds, sovereign wealth funds, and they have enough money and enough power that they can demand it. And it's really your choice as a manager. You can not give transparency and not get money, or you can open it up, and I think you're totally transparent and liquid. I mean, 5 days notice on a monthly basis, you can have your money back.
And again, it was, I think, a popular misperception as well. I think the information was there. There just wasn't a desire on the part of regulators or politicians. I think they should have spent more time actually looking at the points that were being raised by people like myself and my peer group with regard to the banking sector. Why was there such a large short position? Why did I have my position in 2-year, 10-year? That now happens. There is a healthy debate now. I mean, the Bank of England has a research team, and it's their role to interview managers like myself to canvass our opinions. But that's post-2008. Bad things happened, and then they were shaken from their complacency. But I think the information was always there, or a willingness to share the information was there.